The most accessible way to get passive income is by investing in dividend-paying stocks. A stock is a company, and when you invest in a stock, you become one of the owners of that company. So if you go out and you buy just one share of the McDonald's company, you become one of the owners of the McDonald's corporation. Now, you don't get any free fries or free burgers with that, but you are one of the owners of the company and you are entitled to a share of the profits. Now, there are some big companies out there like McDonald's that make so much cash, and at the end of the year, they have all this cash in their bank account and they just don't know how to invest all this extra cash back into their company. So what they do is they just take this extra cash and throw it back at their investors, people like you who own their stock. And so you get a check every 3 months typically, and this check, this passive income cash that you're getting just for owning their stock, is called a dividend. Now, not every company pays a dividend. It's typically going to be your bigger companies, your more established companies, because these are the companies that are making a ton of profit and they just don't know what to do with their extra cash. Like McDonald's, for example. McDonald's pays out a 2.5% annual dividend yield. What that means is if you went out and you invested $100 into McDonald's today, over the next year, they would pay you $2.50. So if you wanted to make $500 a month in passive income from dividends, well, $500 a month times 12 months, that is $6,000 a year. So now we got to work backwards. I had to get a new black marker because that one was dying. But if you want to make $6,000 a year, which is $500 a month, well, if you're getting a 2.5% return, that means you got to do $6,000 divided by 2.5%. Look at how nice that marker is. Well, now that means you have to invest $250,000 into the McDonald's company today in order to make $6,000 a year, which is about $500 a month through dividends. Now, I get it, $250,000 is a lot of money. And even if you did save up $250,000, throwing it all into one company just because they're paying you a 2.5% dividend probably isn't a good idea. But what the good news is that some companies pay out even higher dividends. IBM pays out about a 5.25% annual dividend, SPG pays out about a 6% annual dividend, and AT&T is paying out a 6.7% annual dividend at the time of me recording this video. The second way that you can make $500 a month in passive income is by investing your money in real estate, which is my favorite place to invest my money for passive income, but there are some roadblocks that you have to jump over to start investing in real estate. Unlike the stock market, when you invest in real estate, you are in charge of your money. Now, this can be good news or bad news depending on who you are, but you can compare that to investing in something like McDonald's. When you invest in McDonald's, McDonald's has their own CEO, they have their own executive team, they have their own board, they have a whole bunch of employees, so they have a bunch of people that you hope are smart enough to run the company and make the company more money. When you invest in real estate, you are the CEO of your investment, and you are the one that's in charge of your investment, and you are the one that's in charge of your real estate, and you are the one that's in charge of whether or not you make money. I have read a ton of real estate books and I have took a ton of real estate courses, and the issue with almost all of these people talking about real estate investing is that they make real estate investing sound so simple and so easy. All you have to do is find a property you like, and you actually don't even have to do this yourself. You can just find a real estate agent, have them find you a property, you buy the property, and then you hand over the keys to a property manager and let them do all the work. Now, in theory, yes, that works. But in reality, if you don't know what you're doing, it doesn't work like that. The first property I ever bought was a small condo. And when I bought this property, I found a property manager. And this property manager wasn't finding a tenant very quickly, so I went out and I found a tenant for this property. Now, I put this tenant into the property, I told the property manager, but the property manager didn't get a lease from the tenant. And this property manager had a contractor that would do work in the property, but that contractor was not licensed. So there was a whole host of issues that I didn't even know were possible because I just hoped that a property manager would do everything for me. So yes, real estate can be very passive because now my investments are very passive. I only spend maybe an hour a month reviewing my financial statements, but to get started and to understand real estate investing, it takes a lot of work in the beginning because you're going to be the one going to properties and you're going to be the one that's looking at renovations, talking to contractors, talking to property managers to learn how it works, and you're going to make mistakes. The thing that you have to understand about investing in real estate in general is that when you see properties with better returns, they typically have more risk, and properties that have lower returns typically have less risk. So if you don't want any headaches, you're going to get smaller returns. But if you're willing to take on more risk, you could potentially get higher returns. So if you're out and you're investing in primetime New York or primetime California, you might only make a 2 or 3% annual return on your money. That means if you invest $100,000 in cash, you might only make $2,000 or $3,000 a year in profit, if that, depending on where you invest. I'm in the Midwest. In my area, you can get a 7% return on your money pretty comfortably. So if you go out and you invest $100,000 in cash, you will make $7,000 a year in passive income from rent in profit. At the same time, I have some friends that invest in real estate, and they won't do a real estate deal unless they're making at least 15% a year on their money. So they're looking at more affordable housing, and they're going into rougher areas, and because there's more risk involved, they can get a potentially higher return. Now, these people also have to deal with more tenant turnover, they have to deal with more evictions and more issues like that, but they're also getting a better return on their money. So you have to kind of figure out where you want to be. The way real estate investing works, like I kind of mentioned earlier in this video, is you are going to buy a property. It could be a house, it could be a multifamily unit, it could be an office building, it could be a mixed-use building. You're buying some property, and somebody is going to use this property that you bought. In exchange for them living in your property or using your property, they're going to pay you rent every single month. Now, what you have to understand here is that the more debt you take on, the bigger your headache. This doesn't mean that you shouldn't take on any debt. I mean, there is a way that you can strategically use debt or leverage in real estate, but in general, the more debt you have, the bigger your headache. But for the purposes of this video, because this is not a real estate investing video, let's assume that you're only investing cash and you're gonna try to get a 7% return on your money. If you want to make $500 a month in profit and you can get a 7% return on your money, that means you need to invest something like $86,000 in order for you to make $500 a month or $6,000 a year in passive income. Again, in the beginning of you being a real estate investor, it is not going to be passive. You're going to have to kind of get over this learning curve. But once you get over the learning curve, yes, once you invest $86,000, you can make an extra $500 a month passively if you can get a 7% annual return on your money, which is a pretty reasonable return if you're in the Midwest. Now, if you're in the West Coast or the East Coast, this is going to be a little bit lower, but this should give you a general idea. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.